Hey dudes and dudettes, it's me, E.H. Ivins, your Uncle Herbie, and this is another edition of The Dad You Wish You Had. Today we're going to talk about investing your money during this time of COVID and crisis. Now, this is a very important subject, and so I'm going to go slowly, but I'm not going to let this carry on for long because let me give you a little background. I spent close to 35 years in the financial services industry. Let me tell you a couple of things about it. I've done, in other words, as a broker and later as a hedge fund manager. Number one is the emperor has no clothes. These guys who are giving you advice, whether you're getting it down at Merrill Lynch or over at Charles Schwab or wherever you might be getting your advice, they don't know their rear ends from a hole in the ground, okay? It is all alchemy, okay? No one knows what financial markets are going to do next. No one knows what's coming down the road. No one knows what tomorrow brings, and anybody who represents that they do is automatically a crook as far as I'm concerned. The fact of the matter is you can do this job for yourself, and I strongly recommend, I am not endorsed by any brokerage firm or company, but I strongly recommend dealing with those companies for your own investments that don't pay commissions. For example, like Charles Schwab or Fidelity Investments or TD Ameritrade or the list, or the list goes on. There are tons of them. I would deal with the brokers that aren't paying the brokers to trade, because the minute you do that, you put their interests at odds with your own. That's number one. Number two, life insurance is not an investment. So let's not discuss life insurance as an investment. Life insurance is death benefit. That's another discussion for another day, that if you want to ask me about life insurance, you need to only look above my head and text my other dad at 844-935-0444, and I will answer questions. But today we're not going to discuss it because life insurance is not an investment. It is a death benefit, okay? Regardless of whether it's whole life or term. Another discussion for another day. I know a lot about it, but I'm not going to get you bored with it today because really, my eyes would roll back in my head from sheer boredom discussing life insurance. Instead, we're going to talk about investing. Now, I'm going to give you my best advice based on 35 years of experience that you can then take and use on your own wherever you want to, which also means that I have no conflict of interest in giving you this advice. I gain nothing. I'm not selling anything. I'm not advocating anything. Go do what you want. This is just my idea of what I would do if I were you. You can do, of course, what you want naturally. Okay, so I began by saying I deal only with a discount broker. So let's say we're dealing with Charles Schwab. Charles Schwab is the oldest and the original discount broker. They have an enormous availability of investments, mutual funds of various kinds, no load annuities, things like that. And they have advisors who are paid a salary, not a commission. So if you go in, they can at least give you basic information and do your paperwork and give you someone to talk to without someone trying to grind their axe on you. Charles Schwab's brokers are not paid a commission. So they are not paid to trade, so they are not going to tell you to sell things you shouldn't sell or buy things you shouldn't buy, at least according to what they think. They're giving you honest opinions, yet their opinions are worth absolutely nothing. They're worth what you're paying for them, which is nothing. So here's 99% of investment success just comes from being in the game, because all ships rise and fall with the tide. The problem is that the tide rises and falls at different times, and we spend a lot of time trying to figure out when that is, when we shouldn't be doing that. In other words, there are really just 5 basic places to invest money. Stocks or equity. In other words, you own part of a business, whether through stock in a business or you're actually running one. Bonds, which is debt, which means you're loaning money either to a business or a government, whether it's a government bond, a municipal bond, or a corporate bond. Cash, which is a bank, CDs, money markets. Real estate, commercial or residential. And what I call my catch-all category, which is hard assets, gold, silver, coins, collectibles, stamps, philatelists, things like that. Now, those are the 5 places. That's it, only 5. Okay, so if you have your money in all of those 5 places at any given time, something's going to be going up because they don't all correlate with each other. Correlate means that when the stock market, for example, goes up, a lot of things, like for example, gold has a tendency to go down because it's a safe harbor when things are bad. But if the stock market goes down, gold tends to go up. That's very simplistic. That's not always true. Okay, that's the problem with financial rules. They're not always true. But as generally speaking, I'm telling the truth. So if you put your money into each of these 5 areas, you're going to have the best diversification and the best chance of having something go up from time to time. So let's pretend today, and I'm just going to use a hypothetical $10,000. It's just a number that is within reach of most people. And before you invest, by the way, that brings me to this point. Before you invest, if you don't have a minimum of 3 months and preferably 6 months of your income in the bank in cash, okay, you have no business investing, because investment means risk. And you should not take a risk unless you have a firm foundation under your house. So that if you lose your job or COVID happens or something worse, you're not sweating it out how you're going to pay the rent and pay for your food bills. You have it in cash in the bank. And although the bank pays a terrible return, it doesn't fluctuate. Risk and reward are connected. The more reward, the more risk. Don't let anyone tell you different. So the purpose of a bank or a credit union is to have a place to park money that has zero risk. So you must first, before you invest another dime, have at least 3 months of your income in cash in the bank. So if you're, for example, making $5,000 a month, you have to have $15,000 in the bank, or hopefully $30,000 in the bank. No investing, no stocks, no bonds, no mutual funds, no annuities, no nothing. Cash. Once you achieve that cash level, then you can move to investing. Okay, that's my first piece of advice. But let's pretend that you've gotten there, and now you've got $10,000 left over to invest. What should you do? Okay, you've got your cash, so we're going to rule that out. Now we've got 4 categories left: stocks, bonds, real estate, hard assets. Okay, let's talk about real estate, which is the hot investment of the moment. This isn't really off color, but there's an old saying that says the masses are asses, okay? And forgive me if that's a bad word that you don't want me to use, but the masses are asses, okay? What it comes down to is most people are wrong most of the time. And people have a tendency to invest like a herd of cattle. It's literally called in the investment world the herd instinct, which means that everyone tends to buy things all at the same time, and that's what creates bubbles. Right now, we have a bubble in 2 areas: the stock market and the real estate market, because people are buying up both stocks and real estate while ignoring the underlying economy, which is not very strong. When you have a disconnect like this, when you have the stock market going up and the real estate market going up while the economy is in the pooper, sooner or later, reality will take over and there will be a major adjustment, which is to say crash, in both markets. So what you don't want to do, oops, that was the light falling into my lap because I knocked it over with my foot because I'm a klutz. And and now I knocked the camera. I am such a technical wizard. Don't take my technical advice, just take my financial advice. Okay, so the point I'm trying to make is, let's not throw all our money into real estate. And buying a house is not necessarily your best investment. I know that's repeated by realtors. They're full of baloney, okay? Your house is not your best investment. The best long-term returning investment traditionally is the stock market, by far. So let's just talk about how to get your money into all 4 places and what to do moving forward with your money. So I want you to put 1/4 of your money into each one of these categories. 1/4 in the stocks, 1/4 in the bonds, 1/4 in the real estate, 1/4 into hard assets. I'll discuss which hard assets in just a minute. As far as the stocks are concerned, divide your money 50-50 between domestic and foreign stocks. Go to see your Charles Schwab or TD Ameritrade or Fidelity, whoever you want. I would mostly use mutual funds because really, do you really want to be a stock picker? It's just, for most people, and I'm speaking in this podcast to most people, not to people who are going to spend all day on the computer day trading. They're not going to listen to this podcast anyway. For us normal people, just buy a no-load, which means no commission, mutual fund at your favorite discount broker. Put half your money in domestic U.S. stocks, half your money into foreign stocks. Why foreign stocks, by the way? Because there's a lot more room for them to grow. The United States is a very mature economy. The economy of a country of, let's say, India is just they're an up-and-comer. There's more money to be made in Indian stocks than American stocks, logically. Just use your head. Then by having a mutual fund be the guy that figures out which are good and bad companies, you reduce the risk. And the fact that mutual funds own hundreds and hundreds and hundreds of different companies, you're very diversified and pretty safe. Okay, so that's where 25% of your money goes. Into the stock market, 50-50, U.S. and foreign. The next 25% goes into bonds. Okay, again, in this case, 50-50, government and corporate, both. Again, through mutual funds, you can buy government bond fund, you can buy corporate bond fund. Your broker and or advisor that is not being paid a commission at either Fidelity or Schwab or TD Ameritrade or the rest will give you advice as to which ones. That's where the next 25% goes. Why bonds? Because they don't fluctuate much and they pay a regular income. You're going to constantly have more money, dividends coming in, interest coming in off the bonds. That's going to build up your pot. That's going to give you more money to invest down the road. And it's going to provide a stable base for your investment portfolio. The third area is real estate. Now, you can invest in real estate through a mutual fund or a limited partnership, and there are good no-load limited partnerships. Again, talk to your non-commission earning broker. That's how you buy real estate. I'm putting your house into a different category. Your house in your budget, your mortgage payment is whether you're paying a mortgage or rent, that's neither here nor there. I'm talking about as an investment. buy a real estate fund and put 25% of your money there. So now we have 75% allocated, and we're moving to the last area. I told you this isn't very complicated. I'm moving along quickly, and you can just replay this and take notes as you go through this so that you get to the bottom line. Now I'm going to get to the most complicated category, which is hard assets. Traditionally, that was gold and silver. Okay, I would tell you to buy gold and silver with that 25%. Not necessarily as an investment, but as insurance. You must view this 25% not as an investment account, but as an insurance account if the whole world goes to poo-poo. I'm not going to get into all the reasons why, because that's politics, and I swore that when I started this podcast I would not discuss politics, but I'm going to tell you that we are on the brink of a major financial cataclysm caused by the amount of money we're printing out of thin air during this COVID crisis, which I believe is going to be the straw that breaks the camel's back and pushes us into our next depression, not recession, depression. The thing that will save you, okay, if this happens, if I'm right, is going to be these hard assets, okay? Now, like I say, traditionally that was gold and silver, which you can buy a number of ways. You can buy the gold and silver directly at a reputable coin dealer. Never buy it from these guys on TV, by the way. Don't be buying it from like Rosalind Capital. Read their prospectus. They mark it up enormous amounts to pay for all that advertising on TV. Go down to your local, if you want to buy the actual gold and silver, go down to your local reputable coin dealer. They'll mark it up about 3%. Everyone's got to make a little bit of money, and the other 97% will be the actual metal. Now, if you don't want to bet, the problem with buying the metal directly is that you got to store it somewhere, and that means a safe, and that means putting it in your house, and that's unsafe. Okay, so if you want to feel safer about it, and you don't want to put it in a safety deposit box because they get locked if you die and things like that, the next best choice is to buy a precious metals mutual fund. Again, your broker or advisor at your no-load place, your no-commission place there are hundreds of them. They'll advise which one you can invest in. And the third way that you can buy it is you can buy what's called an ETF, an exchange traded fund. There's one on the New York Stock Exchange called GLD. That's the symbol, gold, GLD. And without, the vowel. And you can just, if you buy that stock, you're buying bullion, essentially, okay? And you can do it that way. So there are different ways to buy gold and silver, okay? And I've left out even a couple more. Half of your 25%, or in other words, 12.5% of your total, under the current system is, I would still put in the gold and silver and platinum and palladium, precious metals mutual funds, okay? The other half, I'm going to strongly advise you to buy cryptocurrencies like Bitcoin, Ethereum, Chainlink, Zcash, etc. Those four I just named, by the way, I own all four of those in full disclosure. Now, having said that, the way you buy cryptocurrencies, and I know you've read about these, and you can read a lot more. I'm not going to go through them today, but basically they're currencies that can't be manipulated by the government, okay? Now, there are those people that think they're a fad and are going to go away, and they're very risky and they're very volatile. As I'm talking to you this morning, for example, my Zcash is down 10% in one day. Now, tomorrow, I'm sure it'll go up 10%. But I don't buy it as an investment. I buy it as insurance, because if the whole world turns to poop, it is this money that I have in crypto that's going to save my bacon. Crypto, gold, and silver, and platinum, palladium, the precious metals, okay? And so I'm not worried about what it's doing today. I'm worried about when the stock market crashes and the bond market crashes and the real estate market crashes, I'm going to have a significant amount of money that I can turn to cash. Cryptocurrencies are very easy to turn to cash in a snap, okay? Now, how do you buy them? You can use a wallet like Coinbase. It's just an app you put on your smartphone. Look it up. They'll walk you through how to do it. And to tell you how widespread and pervasive crypto has become, PayPal has just entered the cryptocurrency market. You can now buy cryptocurrency through PayPal. It's a brand new program. I'm not altogether familiar with it. I use one of the other wallets, but again, do your research. It's very simple. And again, I don't want to necessarily point you towards a specific company per se. I know I just said PayPal, but they're not paying me anything. I don't want to have a conflict of interest in the advice that I give you. So all of this that I've told you is uncompensated. It simply goes to good advice. So let me just review it and we'll get to the end of this today. There are 5 places to invest money. You need to put money in 4 of them. You need to get at least 3 to 6 months of your income in cash in advance, then put 1/4 of your money in stocks, 1/4 of your money in bonds, 1/4 of your money into real estate, and 1/4 of your money into a combination of precious metals and cryptocurrencies. By doing this, you have your money in every possible area money can be invested, and you have the insurance of knowing that if the world turns to manure and we end up in a depression or a hyperinflation or some combination of both, which is a real possibility right now, you will be protected. And that's all you have to do. Now, Once you make this allocation, there's one more step that I need to cover before I sign off. The one thing I know, I don't know what any of those things are going to do tomorrow, let alone a week from now or a month from now or a year from now, but I do know they're going to fluctuate. Some are going to go up and some are going to go down. Now in investing, the key to all investing is to buy low and sell high. So every 3 months, and this is all you have to do, every 3 months, I want you to go to your statement. If you buy all of these through one brokerage firm, like let's say Schwab, again, I don't get a penny from Schwab, I swear to God. I don't even do business with Schwab. I'm just using them because they're well known. If you go to Schwab, you'll have all your investments in one account on one piece of paper. And the one thing that's going to be sure is, let's say you start out with $10,000 and you put $2,500 into each, they're not going to all be the same balance at the end of 3 months. Some are going to be up and some are going to be down. You're going to take the money, you're going to take whatever your total is. Let's say your 10,000 grew to 12,000. That would be, in other words, instead of to be equal, every account would have to have $3,000 in it. But some are going to have more than 3,000, some are going to have less. You're going to transfer money, which, by the way, should cost you nothing at these discount brokers. You're going to take money out of the funds that are up and put them into the funds that are down. Now, why are you going to do that? Because you're supposed to buy low and sell high, and most people can't do that unless they have a discipline. In other words, we all know we should buy low and sell high, but that means buying things out of favor, which is really hard to do when all your neighbors and friends are telling you you're an idiot. So, for example, I just told you that real estate is a bubble. I just told you you'd be nuts to be buying lots of real estate right now. But most people are. Why? Because the neighbors are all doing it, because their friends are all doing it, because all the financial rags are all telling them to do it. Is it smart? No, it's the herd instinct. It's like a herd of cattle running over the cliff together. But it's very hard to know when to buy and when to sell. So instead of trying to figure that out, just pick an arbitrary point in time. I do it every 3 months. You can do it every 6 months. You can do it once a year and rebalance your portfolio. That's what it's called. Rebalance your portfolio. Take out of what's up to put into what's down to make all 4 accounts equal at the end of every 3 months. And just do that religiously. So you will always be buying low and you'll always be selling high. And that's the best you can do, okay? And over time, you will do better than all your friends chasing all the investments that are popular at the moment, and you will find yourself a much wealthier person and live happily ever after. Now, I know that I just covered a lot of ground in a podcast episode. So listen, play it back, take notes, figure out what's going on. I'm telling you, the advice that I gave you is better than the advice you've gotten from any broker or any financial advisor anywhere. And most importantly, I don't make a commission, and it's the truth. End of story. Now, before I go away today, a couple of things. Number one, look right above my head. As I said earlier, you'll see My Other Dad. Text it to 844-935-0444. If you have questions, financial, raising children, anything you would ask a dad, text it to that number and I will answer it in a future podcast. That's number one. And by the way, always anonymously. Number two, I want you to pick up a copy of my novella called The Terrarium. Now, I'm a writer, and The Terrarium has nothing to do with anything other than it's a coming-of-age story of a boy 9 to 13 growing up in the 1960s, a time of tremendous social and societal change, not unlike the time we live in today and what he went through to do it. It's a wonderful story. It'll make you laugh. It'll make you cry. It has every element a good story should, and a great ending. Now, you can get it one of 3 ways. You can download it onto your electronic reading device from Amazon. You can get a paperback hardcover copy or a print copy from Amazon. Or you can, if you're a Prime member, you can download it and read it for free from the Kindle Lending Library. Regardless of how you pick up The Terrarium, I will get a little bit of money. You will help support this podcast. And based on the nature of the advice I've been giving you here in this very early nascent stage when nobody's watching, but us, our little group, I hope you think that the advice I'm giving you is worth it. Now, that brings me to one last point, and then I'm going to sign off, which is, after you click the subscriber button and the notification button, be sure to share this with all of your friends, because the algorithm that shares YouTube videos in the search engine doesn't come into play until you have 40 or even 50 episodes in the can, and right now we have about 15. Consequently, we're not getting picked up by the search engine yet, so the only way that people are going to find this advice that I'm giving you is if you share it. So please share this with your friends. And that's where I'm going to leave it. I want to thank you very much, as always, for joining me. I will be doing these podcasts, just for those of you that are new, twice a week, every week. I've been doing it since I started it. I will continue. I record every Tuesday, and I know I'm recording on Wednesday today, but that's because the election was yesterday, and I wanted to wait for that to be over to see what was going on. But generally Tuesdays and Fridays, then it comes up a day later. You'll be notified if you click the notification button, of course, and that's it. Thank you very, very much. I hope you enjoyed all this advice, and until next time, this is E.H. Ivins, your Uncle Herbie, saying so long.